The power of compound interest. Make your money work for you. Imagine a world where your money multiplies itself, where every penny you save grows effortlessly. Welcome to the world of compound interest. What is it? How can you become an expert at it? Stick till the end and we will show you everything that has got to do with compound interest. Let's begin with a simple question. If you had $100 and it grew by 10% every year, how much would you have after 1 year? Well, that's right, $110. Now, what about the second year? Not just 120, but 121. The extra dollar is the magic of compound interest. Think of compound interest as a tree. The initial amount or the principal is like the seed. The interest is the new growth, the branches and the leaves. And as time goes on, those branches grow their own branches. So how is compound interest different from simple interest? Simple interest is calculated only on the principal amount or on that portion of the principal which remains unpaid. But compound interest, it's interest on interest. Compound interest is not a new concept. It has been understood and utilized since ancient civilizations, a testament to its power and significance. Compound interest is a powerful tool, regardless of where you are in your financial journey. Whether you're a student saving your allowances, a professional planning for retirement, or anyone in between. Now let's dig deeper. Part 1. The magic of compound. When you hear the word magic in relation to finance and investments, it might make you skeptical. Yet there is a phenomenon in the finance world that many have fittingly named magic, and it's all about compound interest. At its core, compound interest is the interest on loan or deposit calculated based on both the initial principal and the accumulated interest from previous periods. In simpler terms, it's interest on interest. But why is that magical? Unlike simple interest, which grows linearly, compound interest grows your money at an exponential rate. Over time, you earn interest not only on your original investment or principal, but also on the interest your money has already earned. This leads to growth that starts off slow, but accelerates over time. The longer your money is invested, the more pronounced the compounding effect becomes. An individual who starts investing a small amount regularly in their 20s can often amass a larger wealth by retirement than someone who invests much more but starts in their 40s. If you're holding investments that pay dividends or interest, reinvesting those earnings can significantly boost the effect of compounding. This is because the reinvested dividends or interest also start earning returns. The frequency of compounding can greatly affect the amount of interest accumulated. For instance, interest that compounds daily will accumulate faster than interest that compounds annually, even if the annual interest rate is the same. A helpful analogy to understand this magic is the snowball effect. Imagine rolling a small snowball down a snowy hill. As it rolls, it picks up more snow. The snow is picked up in the initial stages also starts collecting more snow. By the time it reaches the bottom, it has grown substantially in size. In this analogy, the snowball is your initial investment. The snow it collects represents the interest, and the hill signifies time. Now let's look at a real-life example. Let's say you could invest $1,000 at an annual interest rate of 5% compounded annually. After the first year, you'd earn $50 in interest, totaling $1,050. In the second year, you'd earn 5% on $1,050, not just your initial $1,000, which is $5,250. This makes your total $1,102.50. By the third year, you'd earn interest on $1,102.50, and so forth. This might seem like small amounts at first, but over several decades, the difference between compound and simple interest can mean the difference of thousands or even millions of dollars. Part 2. The math behind compound interest. Understanding the mathematics of compound interest helps you appreciate its power more deeply. Let's break down the mathematics that gives rise to what Einstein famously called the eighth wonder of the world, the compound interest formula. This is where A equals P times 1 plus R divided by N to the power of NT, where A is the future value of the investment loan including interest, P is the principal amount, the initial amount, R is the annual interest rate or decimal, N is the number of times interest is compounded per year, and T is the number of years the money is invested or borrowed for. If we break it down, P, which is principal or P, this is the initial amount of money you invest or deposit. Interest rate, or R, expressed as a decimal in the formula. It represents the percentage return or cost on the principal every year. Number of compounding periods, or N. This represents how often interest is added to the principal. For instance, If interest is compounded monthly, N would be 12. If it's compounded daily, N would be 365. T, or time, the number of years you're looking to invest or borrow money for. Let's use the formula with our previous example where you invest $1,000 at an annual interest rate of 5%, compounded annually for 3 years. Plug these values into the formula. After 3 years, your investment would grow to $1,157.63. The power of frequency. Let's modify the example slightly to see the impact of compounding frequency. Suppose instead of compounding annually, it compounds monthly. N equals 12, which means compounded monthly. Notice that the end amount is slightly larger with monthly compounding, even at the same annual interest rate. This increase becomes much more pronounced over longer periods or at higher interest rates. Part 3. Practical applications. Compound interest isn't just a theoretical concept. It plays a crucial role in our everyday financial lives. By understanding its workings, individuals and institutions alike can make more informed financial decisions. Let's delve into some of the real-world applications of compound interest. Number 1. Savings accounts. Description: many banks offer interest on savings accounts. While the interest rates are typically lower than other investment vehicles, compound interest still applies. Application: if you deposit money into a savings account with a compound interest feature, over time not only does your principal earn interest, but the interest earns its own interest as well. Number 2. Certificate of deposit, or CDs. Description: CDs are time deposits with banks. You agree to leave your money in the bank for a fixed period, and in return you typically get a higher interest rate than standard savings accounts. Application: interest on CDs often compounds, making the final return larger than expected from the advertised annual rate. Number 3. Retirement accounts. Description: these are long-term investment accounts designed to grow your retirement savings. Application: given the extended time frame for these investments, the magic of compound interest can drastically increase an individual's retirement savings, especially if started early in one's career. Number 4. Credit cards. Description: credit card companies charge interest on unpaid balances. Application: unfortunately, compound interest isn't always in our favor. If you don't pay off your credit card balance in full, you'll be charged interest, not just on the principal amount, but also on the previous interest. This can make outstanding debt grow alarmingly fast. Number 5. Loans. Description: whether it's a mortgage, student loan, or personal loan, interest accrues over time. Application: understanding the compound nature of interest on loans can influence decisions on repayment strategies. Making more frequent payments, for instance, can mitigate the compounding effect and reduce the total interest paid. Number 6. Investments, stocks, bonds, and mutual funds. Description: when you invest, any returns, whether through interest, dividends, or capital gains, can be reinvested. Application: by reinvesting dividends or interest, you can increase the total amount of your investment, generating higher returns through compounding, leading to exponential growth over time. Number 7. Business growth. Description: businesses that reinvest their profits can experience a form of compounding growth. Application: if a business consistently reinvests its profits into expansion, research, or other growth opportunities, it can experience exponential increases in revenue and profitability over time. Compound interest is ubiquitous in the financial world. The principles remain the same, from growing wealth through investments to the rapid accumulation of debt on a credit card. Understanding the mechanisms of compound interest in these practical scenarios can empower individuals to manage their finances more effectively, optimize investment strategies, and be wary of the pitfalls of compounding debts. Embrace the power of compound interest and watch as your money works for you, crafting a brighter financial future. We have a second video coming up for you guys, so do wait for that. Till then, keep investing.